Hello, everybody. This is BearBull Traders and our Talk with Traders podcast. Today, I have the opportunity to talk with Andrew McEvoy. Andrew's got a unique background. So Andrew was a trader and worked for two major banks with JP Morgan and UBS in Hong Kong. He had an experience to work with those that manage the algorithms and sort of manage some of those algos himself, as well as the quants. Quants are the quantitative traders who actually design the algorithms. And through that experience, it gave him a great insight that when he left the bank, moved back to Dublin, Ireland, where he's from, to trade for himself, he's taking that information and using it to develop his own trading strategy. Andrew is a new retail trader, but a guy with 3 years of banking experience. And it's interesting to talk to his perspective, so hear his perspective and understand how he's applying that. So without further ado, let's get to the podcast. So Andrew, welcome to the BearBull Traders podcast. It's good having you.
Thank you very much. Happy to be here.
Yeah. Well, look,
happy to be here.
Why don't we start with some background, because you were referred to me by a number of our members who I guess you've been talking with, right, through the chat and elsewhere, and they said, you know what, there's a guy you need to talk to. You need to reach out to Andrew McEvoy. So why don't we start there? Tell me, how did you get involved? Because we'll go into your deeper background later, but tell me how you got involved with BearBull Traders.
So I was a trader in Hong Kong, as we'll chat about. But I moved home, and I actually I decided to quit my job in Hong Kong as a trader to come back, because my dad has actually been struggling through a bit of cancer, but he's actually doing much better now. So this is actually I'm saying this because it kind of speaks to the power of. I'm only touching on that point because it kind of speaks to the power of the community, and there's not many trading jobs in Dublin. It's not exactly a financial center. Right. So my little brother, who started trading the meme stocks before Christmas, bought Andrew's book.
Okay.
And so after I quit my job in Hong Kong and I came home, I picked up that book, and I was like, oh wow, because I was initially planning on moving to London after quitting my job in Hong Kong, because I'm then traveling back and forth between Dublin and London, which is about an hour flight. Every weekend to see my dad while he was going through his treatment and everything. But after reading the book and kind of seeing that this was what I was doing in Hong Kong, except with clients' money. So now I was thinking, okay, this has actually enabled me the chance to stay here and live in Dublin and trade myself. And so just picked up the book that my little brother bought to try and improve his GameStop trades, which I'm now trying to apply to non-meme stocks, I guess.
Look, the old meme stock trade. Well, I shouldn't say the old. It's brand new.
Yeah.
So many people.
Yeah,
wow.
Yeah, I know. So I'm only touching, not trying to bring across a sob story, more trying to get across the power of like something like the community that is BearBull Traders, and kind of just how great it's been being in here for the last 4 months and thinking, this is class. I love this. I'm able to stay in Dublin now and trade.
Well, that's fantastic. Well, look, you've alluded to a few things that are fascinating in your background. So let's start there. So you went to, as you mentioned, you're sort of back in Dublin, but you went to university there in Dublin.
Yep.
And then it looks like you moved and went to school in Beijing. Is that right?
In Beijing. Yeah, I did indeed. So I've always followed markets, and back around, I guess, when I was kind of like 15, 16, reading the Financial Times, every single articles about the Chinese economy and how that they were going to take over the world and et cetera, which they're kind of doing, if we're all being honest. So I picked my course in college here in Dublin as international business with Mandarin as my Chinese as my minor.
Okay.
So I did a year abroad. Study year abroad, and then I went back after I finished my undergrad to study my finance master's in Beijing, in Renmin University there. So, and to kind of continue my trying to improve my Mandarin skills, I guess.
Right. Well, and that seemed to have then parlayed it. Once you finished your master's, you ended up at JP Morgan for a while, I presume in Hong Kong.
Yep.
And then
Yep, was indeed.
Right, and then moved from there to USB. So you've got experience not only as now, right, as a trader on your own, but sort of within an institution. So why
Yeah.
don't we start there with the institutional trading? Because we talk about it a lot, but
Yeah.
most of us, most traders, have never actually traded from inside a bank, right, where the big money sits. So why don't you give
Yeah.
us a feel?
Hmm.
Because you actually were focused on, I would say, some of the leading edge stuff, right, with the algorithmic trading and the quant
Hmm.
stuff. So why don't you give us a
Yeah.
feel for what you did with the banks?
Yeah, 100%. So I guess starting off with JP, I've got kind of a good, the two roles I had were kind of, they're quite different. The one in JP versus what I was doing in UBS, but they do give quite a good overview, I guess, of how the equities business works within banks. So
Right.
I'll try my best to explain that as thoroughly as possible. So the job I was doing in JP Morgan was called prime brokerage sales. So I guess how you can think of that is like the banks work like interactive brokers do to hedge funds.
Right.
So I guess like we're the client, interactive broker is our broker. JP Morgan would be the broker of X hedge fund.
Right.
So the job of the prime, and that's the brokerage, I guess they call them prime brokerage because they see the hedge funds that they get on as their clients as the prime kind of the finance world. So what my job there as a salesperson was to try and I don't know. I remember when I think it was plus 500 that I made my first account in like years ago, and someone called me like the next day and was like, "Oh, great to see you're a client now." Blah blah blah. So that's kind of what my first job was. I was responsible for finding what new hedge funds were opening in Asia, or if there was say a US fund that was opening an office in Asia. I was responsible for getting in touch with them and trying to get them to use JP Morgan as their broker.
Okay.
Um, so that was quite an interesting role because I got to see it's not the markets trading side of things, but there's a huge amount of work apart from that and a huge amount of money that's made by the bank aside from just the trading part of having the clients kind of trading through JP Morgan as their broker.
Well, that's something you made me
Because
think of that I was going to say. Like, there's a lot of money that we don't always appreciate as a retail trader,
yeah,
that is
yeah,
made just from acquiring that business, so they trade through them because that volume
yeah.
throughput is extremely valuable to banks.
Huge, yeah, huge. And one massive thing is that so there's, I guess, to break down the prime brokerage side of the business. So basically, within banks, the equities businesses are usually broken into markets, which is the trading side, and prime brokerage. So within the prime brokerage side, you've got the sales job, which was what I was doing.
Mm-hmm.
And then you've got the margin team, which are responsible for giving the margin rates. So basically, if the sales team contacts hedge fund X and say, "Hey, look, we've heard you've opened an office in Asia. We'd love you to become a client of ours." And then they would say yes, no, or they'd say, "Yeah, okay, let's see what your margin rates are like." So what they would do is they would send us in a sample portfolio.
Okay.
And then what happens is we pass the sample portfolio. That's kind of our job done then in a way.
Right.
And we pass that sample portfolio on to the risk and margin team. And they go, okay, so this client, hedge fund X is, is kind of active in X industry or X sector. It looks like a good client. We'll give them a margin rate of, let's say, 5 to 10%. And also this is kind of at the stage where you decide how much leverage this client is allowed.
Right.
So and it varies quite significantly depending on the client type as well, because the quant guys like the Citadels who have a hedge fund side as well as their market making side, which kind of, again, how suspicious is that? But anyway, I've always hypothesized that there's no way the guys in if the market maker guys are having a beer after work with the hedge fund guys at Citadel, they're kind of, I struggle to see how those Chinese walls don't come down for a second and the secrets get passed over. But anyway, again, that's more the tinfoil hat stuff, as Thor likes to call
it. And it's hard not to say, right? Because I mean, it's funny from the outside, we can just sit and shake our head. But I mean, the reality is, like the banks, and correct me on anything I'll say now that's wrong. But I mean, as a bank, major sources of income. Well, they make money on order flow, sort of charging transaction based fees for that activity. They make money on, like you said, on margin, because in providing margin they sort of get
Yeah.
they get a collection rate based on providing credit through to their clients based on the margin.
Yeah.
But then they also make money on
Yeah.
the arbitrage between on sort of the equity issuances, right? So where they can take
Yeah.
fractions of pennies off the price in advantage when the buy and sell transactions happen. That's another side. So
Hmm.
they sort of they get to make it on all
Huge.
fronts.
Yeah. And also another huge thing that the margin and risk team are responsible for is if they find client X is very similar and takes the opposite side, usually to client Y, they'll go, oh God, these two books are perfectly match off. So one thing that people kind of get a bit confused with is banks, since the introduction of what was called the Volcker rule after the '08 recession, is banks, especially within the equities department, can't really take much risk anymore.
Okay.
A lot of the guys who would have been the big risk takers in banks left. I know this from talking to some of the guys who left post the '08 '09 recession, is because of the Volcker rule. They can't take much risk sitting within a bank anymore, because
Sorry,
the guys sitting in.
Andrew, when you say they
Sorry,
can't
go
take
ahead.
much risk, meaning they can't do like they used to and trade big money on their own accounts,
Yeah,
meaning buy volume of
yeah.
stock.
They can't use the bank's capital anymore to
Right.
basically. They can't use the bank's money to make profit for the bank. Yeah, because they
Right.
were seen as too systemically important to be taking as much risk as they were pre the recession. So a lot of the guys who were the big risk takers within these banks pre the kind of post the introduction of the Volcker rule, all left and went to hedge funds,
Right.
because they were then able to keep going within that kind of risk taking role. So
Yeah.
one of the most important things now is, and really what a lot of what kind of hedge funds and mutual funds, or long only funds as they're called, they use banks for basically to get the price that they want, that like for whatever trade they're in. Right. So they now care really, like banks are there now more so for reaching that price benchmark that the client wants. So if you see, if the risk and margin team, going back to that point, if they see two clients that kind of offset each other quite well, and they trade quite a bit against each other, and they're able to match VWAP over the day for these clients, and get them a better price performance and hit that benchmark perfectly, they'll be quite keen to get these clients onto their books. And because I mean, at the end of the day, all these clients care about is kind of whether you're matching their price benchmark or not. Mm-hmm. And that kind of then filters through to the performance of, I guess, the equity side, then apart from the prime brokerage side, in that the algos in the equities department is responsible for basically trying to achieve the price benchmark that the client wants.
Okay, so let's dig into that. So how do these algos go and try and achieve that price benchmark?
So I guess talking about the offsetting, I know within some banks now there's basically there's an auto complete option. So if client X sends in an order to buy 100 shares of Apple at VWAP over the day. So algos generally, when they're trading VWAP, the client wants VWAP for the full day. If you're unless they set like an end time for the order at 12 p.m. But generally clients want VWAP over the day, because that's their price benchmark. So if client X comes in and wants to short sell 100 shares of Apple at VWAP over the day, and client Y wants to long 100 shares of Apple like a VWAP over the day, they'll just straight away auto complete that, and then they'll match the two prices against each other at the end of the day post market. So that's one way that they've really started to kind of ensure that the price performance or the performance in achieving the client's benchmark has improved a lot recently. And that's something that some of the banks are bringing in and kind of trying to kind of improve their performance in achieving that benchmark. And also we'll get notifications if one client is trading the same stock except on the opposite side. So again, using that example of if client X is long 100 shares of Apple and client Y is short selling 100 shares of Apple, we'll get a notification, and if I know if it's kind of a sensitive client, I'll call them up, and I'll be like, hey, listen, I can see we have an opposite side order. Well, we would never exchange any information about kind of. The client would always stay anonymous to any other client, and they'd never ever know. But it's a value added service to that client to call them up and say, hey, listen, I can see you're trading this stock and you want view up over the day. I have an opposite side order on my trading pad now from whatever. Well, you'd never say the client name, but are you interested in crossing at such a price over the day? They'll say yes or this or no, because they may have a view. The traders at the hedge funds may have a view that this could get better. The price could get better for them over the day, and they say no, it's grand. I'll leave it.
Right now.
And then so that's kind of.
You're using numbers that our retail traders are familiar with, but we're not talking 100 shares. Normally, that's 100,000 shares or a million shares, right? That we're talking about.
Yeah, no. I mean, I've personally, yeah. I mean, during my time as a trader, I personally had orders that were over $100 million.
Sure.
That I was watching trade over the day. So I mean, it's important to know kind of now that I guess. I'd say 60, probably upwards of 65% now of flow goes through algos in banks. It's not through the Wolf of Wall Street kind of method anymore, where everyone's hollering at each other on phones. Yeah. It's I mean, I could easily have 400 or 500 trades for my clients on my pad at one day, and I'd touch or intervene in probably like 1% of those, because I mean, just to make sure that the algo's doing what it's doing, that it's hitting its this price benchmark. And then if there was something, because I mean, algos aren't perfect, right? So they can't predict everything that's going to happen in the market, obviously. So if I can see that if an algo is performing quite badly and it's really not hitting its price benchmark, I can then intervene and trade that manually, because just to see if I can improve the price performance or not. Right. Yeah, so there's kind of, to expand on the kind of the price benchmark side of things, there's a few main price benchmarks that clients care about, which is VWAP over the day. Yeah. They want to achieve the open price, which the order would. This is one of the reasons why the open is so volatile, because you've got these huge orders coming in, and so if hedge funds could have a strategy which specifically targets the opening price, and so they could have these huge orders sent in, and you've got all these, as Thor likes to say, buy them, sell them, buy them, sell them. They have all these huge orders coming in at the open that are all trying to achieve the open price, which creates this huge volatility. So that's one. There's clients who want to achieve purely the closing benchmark, so they would trade only in the closing auction. So you've got VWAP, open, close. You've got arrival, which is basically the last printed price when the order is sent in. So let's say if you send a trade in at 10 a.m. and it's for Apple, and if it comes in at 10 a.m., the last printed price in the market is $105. That's arrival. So you need to try, if you're buying, you want to try and buy at a lower price than $105. Okay. Or if you're selling, you want to try and beat that arrival price by selling above $105. Right. And all banks have various different algos which try and beat this whatever price benchmark that the client has kind of set for the trade. Right. So they're pretty much the main ones. And there's now been more of an introduction of what are called opportunistic algos by banks, which I was pretty surprised when I was going through all the market auction theory stuff of how similar they are. The so-called opportunistic algos that banks are using, how much the logic and theory behind those algos ties into market auction theory. Because there's things like if the algo sees that, if the price seems to be coming our way, if the price is basically, if you're buying and the price seems to be dropping, the algo will basically pull its order and post deeper in the book because it thinks it'll be able to buy cheaper. Right. At pretty soon. There'll be things like book imbalance. So the book will look through the book. the algo will look through the order book and see where the big deep pockets of liquidity are. And it will see if how imbalanced the book is or not. So as market auction theory sees, if they see that there is a huge like order up above, it'll kind of, and it's selling, it'll kind of wait and it'll see, okay, wait, there's a big order back up here. The price could come this direction. Let's pull back and sit back and hopefully get a better fill up top.
Right.
And then it also looks at things. It has a lot of algos now send out kind of, I'd say I wouldn't say multiple orders, but they now have what are called like aggressive and passive slices. So say if you're buying, they will sit and they'll sit an order on the bid side, but now they also have the ability to send orders and cross the spread and start hitting orders on the ask, so that they can make sure that they're still being involved in the volume and that they're not missing. Because like the last thing you want is for the algo to get too smart and basically think, oh no, the price will come back down, but it keeps going, and you end up buying later on in the day. So it always has to be chipping away throughout the day, just kind of buying little bits, because also the last thing you want is and it's happened where something's gone wrong and the client's rang me and it's like, well, I haven't been filled in 10 minutes. What's going on here? Because the client expects, fills pretty frequently.
Right.
So it's that you sometimes get those pretty angry calls from clients, which is not too much fun.
I imagine not. But this is fascinating from a retail trader point of view, because this, as you say, ties into a lot of the stuff that we talk about. We do it from a lot where we only see the result of it. We don't understand the motivation. And Andrew, I really appreciate it, because this helps maybe explain some of the motivation. For example, we talk about when you look at the level 2, whatever tool you're using, we tend to use DAS Pro, but it doesn't really matter as long as you've got access to the level 2 information. We see these big orders that may sit down on the bid or up on the ask and say, well, they sort of act like magnets, right? Because we find that the price tends to get drawn towards those big orders, whether it's up or down, depending on the direction of the price movement. But what you just said, Andrew, helps explain why, right? Because if you have other orders and algos that are saying, well, we're going to drip feed so we keep the momentum going, because they also want to make sure they're part of the game, but they're going to be holding back a lot of volume, waiting for that big order, which frankly just makes that price point even more attractive. That sort of just reinforces the theory and why it works that way. So and for example, Andrew, what you said makes a lot of sense to me, because it helps explain, use an example. You've been talking Apple, so let's use Apple for example. Sometimes you'll see a big order, let's say at $149, and when it hits that, I always notice it consumes that volume, but then it continues to pop because essentially it exhausts all the immediately available inventory that's on the bid. But if you've got other orders that are backed up and algos that are waiting for it, well, then they're likely to get filled at 149 or 5, 10, 15 until those get exhausted, and that just further pushes the price.
And then as you see, as the price runs, once it gets through those big pockets of liquidity, a lot of the algos logic works off of, if there's a lot of prints going through on the far side of the spread, I need to get involved in that liquidity, because especially so one big thing, which is I wouldn't say it's a pretty new concept, but it's a pretty big algo that clients are getting more and more more kind of interested in, was when they see these big pockets of liquidity sitting at a certain price that is cheaper than historical averages. So let's say I'm sure people have seen a big order sitting up at a certain price on the ask, and it suddenly just runs for that. Right. There are algos which look through the book and look at that pocket of liquidity and go, okay, we've got 200,000 shares of Apple on the ask for a price that is quite cheap versus historical averages. So I need to go and consume this liquidity straight away before someone else does. Right. So it will literally cross the spread, go through 4 or 5 levels, and just eat up that liquidity. And then I'm sure, as we all know, when it gets through these pockets of liquidity and it the price keeps running, that's adding fuel to the fire, because the other algos which are in the market are seeing the prints go through on the far side of the spread, and they're like, okay, this is a lot of prints versus historical averages going through on the far side. I need to go and contribute to this, or need to get involved in this before the price gets worse. And which will just, as I was saying, add fuel to the fire.
Yeah. So I'm curious. So then, as someone who's come from that environment with that experience and moved to a retail background, how do you find you can best leverage that experience to profitably trade for yourself?
I kind of, through knowing 100% that you need to trade with the institutions. There's no way that you're going to be able to outsmart them. Like, and I know, so within UBS, we all used to sit in, like, UBS is a phenomenal place to work. It was incredible. I absolutely loved it. And they were so big over in the kind of, especially in the electronic, it's called electronic trading, kind of the algo space. And they were huge. They'd be huge over in Asia for a long time. And they had a really good, really great kind of team atmosphere. And one of the big things was I before people think that you need to be some sort of genius to trade algos in a bank, you don't. I can't code. I can't do anything like that. You just need to, because the way I kind of like to, because people, when you say to people, they're kind of like, oh my God, you must be some sort of computer genius. And I'm like, no, definitely not. But the way I like to describe it is the algos are a car. So like you like, they're like, basically, I know how to drive the car. I don't know how it's made, or I don't know how to make a car.
Right.
So that's how it works. Is the quants are the guys who are the complete wizards and geniuses, and and we used to sit very close to them. And they were just some of the smartest people I've ever met in my life. They're like, so I mean, having sat beside them and knowing that they're behind the logic that the algos work off of, there's no way I'm trading against those guys.
Sure. And is it like you make me think of a typical like engineering loop where, so using your car analogy, so while the quants are the guys, like they're the engineers who really built it and built the car, so to speak, in this analogy.
Mm-hmm.
And they must look over and see, well, if this is how you're driving it, I might change my engineering on the car. I'll change how it functions or change the algo because you're not driving it the way I necessarily expected you to.
Yeah, and also we may be not driving it the way they expected us to, but that's maybe because there are some market nuances which you just simply can't account for through coding and math and everything. So there's heaps of dry runs that you'll do with algos that get released, and new kind of whenever a new algo is released, you'll do test runs with kind of test orders and see how it's interacting with the market. And again, you can't predict everything that's going to happen. And also, a lot of the time, they may be, the algo can potentially trying to act too cutely and trying to get too good of a fill. And clients sometimes don't really care; they just want to get filled.
Yeah.
Because a lot of the time, like how it works on the client side is within these hedge funds, is they've got a portfolio manager who's passed through the stocks that he wants to buy that day onto the traders who work in the hedge fund. And the trader just cares about getting their PMs, their portfolio managers, or their PM as they're called, shorthand. They just care about getting their PM's order filled, because the last thing they want is to getting shouted at.
Yeah.
I'm saying, why have I had an order for 1,000 shares of Apple, or in their case, I don't know, 1 million shares of Apple. Why have I only got 990,000 shares filled? And I guess talking about big orders, I'll touch on. So there's a few different teams that work. This kind of for the listeners to kind of get a sense of how the broader equities kind of team works as well. Is so I guess there's a team called the blocks team within these equities, the equity side of the franchise, where they'll deal in purely big ass orders, like percentages of companies, like nothing under $10 million anyway, that's for sure. And they'll deal with a lot of the new issues of any secondary listings, or they'll be involved in some IPO stuff as well. But that's a pretty cool side of the equities business, where these guys deal in like proper huge volume. And these are the huge block trades that you see printed off market. And the reason people kind of see that as a weird kind of why are they being printed off market? Why aren't they why aren't they involved in the normal daily volume? And if these big block trades are printed during the normal trading hours, it would potentially, first of all, it would tank the market potentially during the day, so they just have to be printed off market because they're such big transactions, and they're usually agreed at a discount or a premium to what the current market price is.
Right.
So if someone's buying, let's say 1% of a certain company, but at 5% discount from the current price, you can't print that during the normal day. You got to print it off market at like between the two clients. I think it's used. I know in Asia it's post market. I think it's post market in the US as well.
Right.
And then there's also the another part of the equities business are the cash sales guys. So these are like because banks are becoming more and more kind of electronified, I guess. The jobs of people kind of ringing up a client and giving them a pitch of a stock over the phone is kind of dying out, and this is what the equity sales guys do. So the equity sales guys, they'll have their own. I mean, they're smart guys, so they'll have their own ideas of what's going to move, of what's a good stock to get in or out of. But their main idea, one of their main roles is to pitch the stocks that the research teams have kind of done their analysis on and say, this is a short, this is a long. Right. And they'll know which clients to call up and say, hey, listen, I know you're heavy in the tech sector. Amazon are going to do potentially going to go to this price or down to this price, and based off of our research analysts, blah, blah, blah. Right. And another big role of the cash sales guys is kind of what's called the corporate action side of stuff. So they will, and this is kind of, it's an interesting part of hearing about those long-term kind of value levels which are set and get defended like till the cows come home. And they 100% do, because one of the jobs of these cash sales guys is to put these, like they'll put some of the big, it's like, let's say it's one of the biggest hedge funds in the world is a fund called Millennium Capital Management. And let's say their CIO wants to get long a certain percentage of a company. One of the jobs of the cash sales desk is to put the CEO of X company in touch with the head of this hedge fund, because this hedge fund guy, before he goes long such a large proportion of the company, he wants to get a pretty damn good insight into how this company's run, who's running it, what their forecast for revenue is, etc. So I'm talking like they'll hop on their private jet as they do. They'll fly over and they'll meet these guys there's usually big events where these CEOs can meet these heads of funds and everything to discuss kind of their game plan going forward as a company. But once if these hedge fund guys decide that, okay, we're in at this price, if the price comes near that price, you can be damn sure after taking the trip over to Asia to meet these CEOs, they're going to defend that price once it comes back down to it. Right. 100%.
Right.
So sorry, go ahead.
No, I was going to say, it's amazing to me how, so what you described resonates with me perfectly, both for my corporate life and just as an investor, right? Mm-hmm. Like I know that, even just as a small fry out here, retail investor, when I get my fund manager who manages my retirement portfolio, says, hey, we were doing this, and I was talking with the principal who talked with the CEO, like that has an influence, right? So as much as you're saying there's so much algorithm driven traffic and activity, there's still a huge relationship component behind these stocks that drives market
for behavior. Sure. 100%, without a doubt. And that's the one thing that I guess I think will never become electronified are these big orders. You can't do it really. Well, first, I mean, they're just too sensitive, I guess. Yeah. That like you want that personal touch, and you want to be able to, it's, I guess, the bigger the order, potentially the more edgy you would get about letting it up to kind of a machine. I guess you want that, you want, or at least you'd want a pretty damn good trader sitting behind that algo watching it trade all day.
Yeah, well, I mean, if nothing else, you actually rewrite the algo in some cases to defend that price, right? So it becomes true in of
Yeah,
itself because not only have you got your trader watching it, but you may
yeah,
purposely redesign the way the computers are trading against it to make sure you maintain that level that you've now feel you've
yeah,
that fund manager with a $500 million of money behind them is, as you said, they've made commitments now to their clients in turn after that conversation.
yeah,
As you said, damn sure they're going
yeah,
to want to make sure that it plays true. Yeah.
yeah, for sure. And I guess actually to touch on that kind of where the $500 million behind this fund manager, kind of where they get that money is something that might be interesting to the listeners as well. Is there's on the prime brokerage side, which I kind of spoke about earlier, there's a specific team called the capital introduction team,
Okay.
and their job on behalf of the hedge funds as their client is to introduce them to these huge pension funds and these huge kind of university endowment funds, and to give them, because I think I could be wrong, but I think these kind of big pension funds and university endowment funds, I think they allocate around 5-10% to hedge funds usually of their, whatever 20 billion they have behind them.
Yeah.
And one of the job of the cap intro team is to, if there's a hedge fund in Asia who wants to go over and meet the university endowment teams in Harvard, Yale, and then the state pension fund and, California, etc. Their job is to kind of be the relationship manager between those two kind of the fund, the state pension funds and the hedge fund to meet to get them an introductory meeting, and to see the hedge fund will then be like, hey, this is us, this is what we do, this is our return over the last kind of 5-10 years. We think we'd be a good client, or we think we'd be a good option for you to kind of park your money with us.
Right. Well, not to get too deep into that, but you're right. There's huge pools of money out there because while fewer companies are offering pensions,
Huge.
those that have pensions, they have multiple requirements. They obviously have to provide for their pensioners, which is their employees that have retired, but they also have to make sure there's enough growth in it to survive the terms and conditions of their pension and be able to service those pensions for the years to come. So you're right. They can't take risk on all of it, but they have to take risk on some of it, or they won't be able to achieve the growth required to maintain the pension pool.
Yeah.
So I know that, like, I'm Canadian, and some of the big pension funds in Canada are like the teachers unions and Bell Canada, and some of our big organizations that have big deep pension funds. And you're right, they get wined and dined all the time because hedge funds desperately want to be able to service part of that pension fund and help drive that growth mandate for the percentage that they're willing to invest in higher risk.
It'd be one of the dream jobs in the world, that's for sure. Just getting wined and dined. But I mean, to be the person that the hedge fund guys look up to, you got to be pretty important.
Exactly. I always say, no matter how big you are, there's always a bigger boss, right? There's always someone to whom you need to suck up.
100%,
100% to make the world go around.
Without a doubt.
So look, you started talking about.
It's kind of.
Oh, go ahead.
Sorry, go ahead.
I was going to say, you started talking about the things that you've learned that you apply to trading as a retail trader. So number one, follow the big money. So I think we firmly established that. Never trade against the big boys. Are there any other key tenets I would say you carry forward?
Understanding how the algos work and having looked at VPA, and because I guess that's kind of look at how the algos work in terms of like seeing if there's kind of if the prints are coming through on the bid side of the book, and there's the kind of like basically if there's more prints coming through on the bid side of the book versus historical averages, the algos will say, okay, the price is coming our way. If we're buying, we can sit there and wait. That kind of ties into VPA a little bit and watching how the price is trading for sure. And also market auction theory is something that ties in quite tidily into how the algos operate as well in terms of the logic behind them. So I think follow the big money, but also kind of follow how the big money operates, which I think VPA and market auction theory really, really work quite well in doing that.
Right. Well, that all makes sense to me. So as a tool, I'm curious, one of the things that a number of our members have started to use is a tool called Bookmap that helps them understand where some of those orders sit. Is that something you use?
Yeah. It's not, but I think it's Mark from Seattle is always posting those in the chat. So whenever he posts one in, I'll 100% look at it and take a look, because I mean, it's something that I guess I'll definitely be getting a subscription to that at some point, but kind of trying to spread. I've paid about $5-6 in subscriptions, all sorts of things so far. So that's something I'll treat myself to once my performance gets better.
Yeah, no, I understand. There are a lot of tools out there, but that's one that seems to have some value. So
but look, it's if it makes any retail trader sound better, the setup costs for becoming a retail trader are a hell of a lot less than the setup costs for trying to become a big proper fund. I know, like when I was at JP, I think the onboarding costs for a client to, once we accepted a client and they were coming on board, I think the onboarding costs were 400,000 US per client.
Wow.
Through all the legal fees and everything. It's crazy.
Wow.
Crazy. So yeah, it's a hell of a lot cheaper to be a retail trader. I can guarantee you
that. well, that's true. Absolutely. Now, before we came onto the podcast on air, we sort of briefly touched on some of the downsides, and you mentioned one of the things that is near and dear to my heart. You sort of said one of the downsides, and hopefully I'm re-saying this properly, but is the fact that you have no backstop. You're sort of saying you're on your own here, and where you had rules and regulations in the bank, here you've got like risk management's all yours, right? Like, so you've got to figure out what it is, you've got to implement it, and you've got to hold yourself to it. How have you found that transition for you personally?
So I guess I didn't find it too bad, because I coming from a role where I was dealing with orders in the tens of millions and in the hundred, like, most of the time in the millions. Right. You had to be so strict in how you were watching the algos trade, how the algo was performing. And I basically just tried to have no lapse in that kind of continuation of discipline, and just bring it over and like start trading with that discipline in risk management straight away. And so, like, I mean, I've had hard stops in my, like, on my DAS platform from day one. And I've got a max loss that I'm never going to blow through, that's for sure. Because I knew, I guess, coming from the background of trading in a bank, I knew how serious of a game trading was, right, and how quickly it can go wrong. So, yeah. And like, I'm not kind of, I guess, I'm not trying to sound like I kind of have a better background ever, but I mean, if I know how quickly things can go wrong, and how serious trading actually is, and how seriously you need to treat trading and not be an idiot, you need to treat it pretty damn seriously, for sure. Well, because it can wipe you out.
Yeah. Well, no, look, that's a great lesson, and I hope everybody listening takes that to heart, that you absolutely need to take it damn seriously. Because, yeah, you're right. I mean, it can go sideways. 100%. It can go sideways quickly, right? And you may have a great trade idea. It doesn't mean they're all going to work. And the worst thing you can do as a trader is get fixed in a perspective that says, I know this is going to work, I'm just going to give it a little more time, right? Because that's usually the road to despair. The problem is, every once in a while we get rewarded for that. But to your point, Andrew, if something breaks whatever you said your stop is, get out. Commissions are cheap, even for a retail trader nowadays. Commissions are cheap. You're better off, get out, reassess. And that reassessment could be 5 seconds, or it could be 5 hours. But if you're trying to day trade, reassess, then make a real conscious decision about getting back in, rather than hoping and praying it'll just eventually work.
100%. Yeah, the best thing you can possibly do, and I found that, is step away, go for a walk, take it easy, don't rush back in. Because I mean, and I was doing it with, it wasn't even I guess it's kind of weird, because I'm not sure if it's worse that I'm doing it with my own money now, or if when we were trading and it was all our own clients' money that we were using in the bank, I guess, I'm not sure if I'd be like, what's worse, if you lose your own money or your client's money? Because either way, you're kind of out of a job.
Right. Well, that's true.
Yeah. So, I mean, it's kind of, I guess I was able to know that I messed up a couple of times, as everyone does, and you just gotta. There's kind of a usual rule of just don't get the same thing wrong twice, basically.
Yeah.
Once you mess up and you get corrected and you understand then why you messed up, just don't do it again, basically.
Right. So
Especially
if you could share,
anyway.
let me ask you on that front.
Yeah,
If you
go
could
ahead.
share then. So when you were within the bank, what was the biggest loss that you suffered?
The biggest loss I had was 50 grand.
50 grand.
50 grand, which is, which was, I mean, not too bad. I mean, I was pretty happy with having that as my worst. But I know there was other traders who had losses which were significantly more.
Yeah.
Put it that
Actually,
way.
that's pretty good. That sounds pretty honest. So now that
Yeah,
you
yeah.
are
No, I
now that you're an independent retail
Sorry,
trader,
go ahead.
what's the biggest loss that you've had with your own money?
So to put it this way, and to understand how seriously you need to take it, I'm still trading in sim, and I have been for the last 2 months, because I understand how much I need to get things nailed and how seriously you need to trade it. So I haven't taken a live trade yet in the last 4 months.
Fantastic.
I'm not gonna leave sim for another at least 2 months. Because
Fantastic.
you gotta have it nailed. You gotta have it nailed. It is all about the system, and if one thing goes wrong, it does all go wrong. It's a domino effect. So yeah, you gotta have it nailed in. So I'm not coming out of sim for another 2 months.
You know what? But I love hearing that. So you, Andrew, is a guy with 3 years of hardcore experience working for the banks. You know, you didn't come out of this say, I got this nailed, and you went live right away. Even you said, I'm going into sim. I got to figure it out, because the perspective on the game, it might be the same game, depending how you want to look at it, but your seat at the game is very different here. So you're spending time to figure it out properly before you go live. So, you know, $50,000 was your biggest loss in the bank, but that was enough to tell you, I'm losing zero until I'm confident I've got this thing nailed. And that to me, that's
And I
brilliant.
guess
Good for you.
Yeah, and I've had that shock where, and I wanted to carry over that feeling of I thought my world was about to implode when that happened, and like my boss, she was my old boss at UBS was one of the best people I ever met in my life, genuinely. She was incredible trader, incredible teacher. She was totally cool about it. She was like, dude, chill. I've had way worse than that.
Yeah.
But I do remember that feeling, and I just remember thinking, okay, when I was kind of started trading by myself, I was kind of like, okay, let's hold on to that sinking feeling and just apply proper risk management and basically don't be an idiot.
Yeah. No, good. Well, look, one thing I really want to ask you before we go is, we talk a lot of the time as retail traders, you know, there's those days or those trades where you swear to God the market is out to get you, right? And you'll put a stop in, and it's like your stop goes and gets picked off, and then the stock price moves against you, right? So I want to ask, from your perspective, does the market care at all about our 100, 500, 1,000 share order out there? Do we get picked off?
I guess it depends on how much you believe in kind of a herding effect. Because I mean, all algos, as I was saying, they look through the book and they look through where the liquidity is. So if you've got people posting their stops all around the same area, the algo's going to know.
Right.
The algo's going to know. So I guess, do they care about? I know of huge clients that we had huge global quant funds, and I mean they were sending in orders. Some of them, I mean, like they were sending in like thousands of orders every day. But like some of their orders would be 500, 1,000 shares. So do they know that this is an order that they're picking off from a retail guy? Possibly.
Right.
Possibly. I guess it's kind of it's hard to know exactly, but I mean, if people are trading in a similar fashion and the stops around the same area, they're going to target that. Yeah, for sure.
Right. But I guess you're giving me the answer I sort of expected, which is they probably don't care. They're not looking for Peter's order or Andrew's order, but they are looking for where those orders sit. So if we put our stop orders
100%
at the same place that people are logically putting a number of stop orders, they're going to look and say, oh, well, look, we've got
Yeah.
50,000 shares here. Now there it may be a thousand orders of 50 shares. They don't really care as long as they get the liquidity they need, and they're saying,
Yeah.
we're
No.
going to go after that because
No.
it's attractive.
They just, they don't care if it's one person or 1,000. They just want the money,
Right.
basically.
Yeah, no, and that makes sense. So
Yeah.
that's something I think for everybody to be aware of. Sometimes it feels personal. I can almost guarantee it's never personal. The computer's not looking for retail trader orders, but they are looking for the place where the orders sit. And if you say, well, after this important daily level, after, like you said, some of these key things, past VWAP, near the open price, there's areas that they're going to say, well, shoot, yeah, if there's orders there, I want those because it fills whatever premise they're going after for their client.
Yeah, 100%.
Awesome. Well, Andrew,
100%.
Andrew, this is great. Like, I really appreciate you sharing some of that background and experience. The last question
Of course
that I'm hoping you can share is, so, you're obviously taking a cautious approach, and I really appreciate the maturity with which you're doing it. You've talked about some stuff that we talk about in the room, from Jared in the morning with the market option theory, and Thor, of course, that talks ad nauseum about VPA and his volume price analysis. You've just reinforced how important that is, because it's part of that makeup of the market, and it's part of what the big money, whether it's being traded by humans or algorithms, is looking for to try and execute against. So that's a lot of stuff we're doing. But if you had one piece of advice to give to any other trader who's trying to say, is trying to figure it out like you are, what would you say would be the most important thing to focus on?
I would say resilience, 100%, without a doubt. I came into my job as an algo trader within a bank with zero knowledge, but you just got to keep at it, and it will eventually click. It does. So just keep. People really, really, really overestimate how smart you need to be to trade. All it takes is hard work. Just work your ass off, and just be, if you have a bad trade, get your ass back up and get back in the seat and trade again. But when you're not emotional.
Right. Well, I think that's good advice.
Yeah,
you're right.
Just keep at it.
I would say sometimes it's almost a detriment to be too smart. Just in that we sometimes outsmart ourselves, right? We try and overthink the market, and we apply more complexity to the situation than it might otherwise entail. Sometimes the story is as obvious as you think it is, but we can still get 100%. Caught up by it. So you know what? I like what you say. Resiliency is important. Hey, we're all going to make mistakes. We're human. Learn from it and just get back up there. And you'll find that over time you can create that consistency. But I think, Andrew, to sort of what you're implying a little bit as well, I don't care how experienced you are, you're never going to be right 100% of the time. Know that this game is a law of averages. And if you're hitting 60, 70%, you're probably doing pretty good, I would think, in terms of hitting those trades.
100%.
And if you can maintain that,
100%,
right? If you can maintain that, then you're profitable over time.
Absolutely. And there was a great trader in UBS who I had the pleasure of working with too, and he was one of the best. And he used to like to say, just keep it simple, stupid. And that was it.
The old KISS philosophy. Love it.
Yeah. Just keep it simple. Keep it simple, stupid. Don't say that too many times fast when you've had a few whiskeys, though. It's not possible.
Yeah. Excellent. Well, on that note, keep it simple, everybody. We appreciate it, Andrew. Thanks so much for spending the time with us today. And for everybody out there, hopefully you'll check out BearBull Traders. If you haven't, check out our website or us on YouTube. We live stream free every morning, our pre-market show. And then you can join the room and trade live with us all day. So hopefully we'll see you there soon. Andrew, we'll see you in the chat room.
Pleasure, Peter. Thanks so much, mate.
Take care.
See you. Bye-bye.